All right, shares of Netflix have bounced back a bit. We're down more than 8% at one point, but now right around 5% after reporting Q1 earnings. Let's break them down with Santosh Rao, Manhattan Venture Partners Head of Research. Good to see you as always, sir. Your reaction to the report, what stands out to you? Why are shares down 5%?
Yeah, I think the knee reaction is down. It's a slight miss on the revenue. EPS is also a slight miss. But I think there's a lot of puts and takes here. They've pushed out the password sharing crackdown to the second quarter. So I think that's going to play out. So for me, the Netflix story was really about the second half of this year. The first half was there's a lot of in and out here, a lot of adjustment going on, rollout issues, friction, and all that stuff. So I think what you'll see is the initial reaction is bad in the sense that I think what's really bad is the guidance. And guidance is bad because they're saying the subscriber count is going to be essentially the same as the first quarter, which is historically the slowest quarter. It's a slow quarter, essentially, one quarter, seasonally slow quarter. So I think for that, I think people are saying, are things going bad? Are people just dropping out? They're not. They don't like the ad base. So many questions come to mind. So at this, we'll wait and see. We'll hear the call, see what's going on. I think it's really a second half story. Netflix is with the first half. We'll have to see. Definitely, the first quarter was slightly worse than what we expected, but we think it's okay. It's within reason why things are happening the way they did.
Yes, Santosh, certainly the push into advertising, a huge focal point within this report, is probably going to be brought up a number of times on the call this afternoon. What does this tell us, if anything, just about the current ad landscape and what that could potentially look like over the next 3 quarters?
Yeah, I think, well, they're rolling out. They said they're trying everything. Either they'll have to increase the CPMs or increase the views. There are a lot of adjustments going on. So at this point, I don't think we know exactly how the ad business is doing, the ad initiative is doing. But it's definitely, they expect it to do very well, and we expect that to do well. It's going to be incrementally positive. It'll stop the churn, lower the churn, if anything. So net, I see a lot of positive effects, but I think at this point, we don't know how it's being received. Who's taking the ad? Are there new subscribers taking the ad part, or is it the premium subscribers coming down? So all those issues have to be sorted out. Overall, in the long term, I think they needed the ad business. That's another revenue engine that they needed, and they have. So there's no question. The password crackdown and advertising is net positive for the company. It will bear fruit in terms of profitability and subscriber growth down the road. But in the initial phases, there's going to be a lot of adjustment and friction. So we'll wait and see what happens. The second quarter number is really the pushing out of the crackdown to the second quarter. I think that's going to lower the subscriber count next quarter. It probably had a slight uptick here, but not as much as we expected in the first quarter. So, like I said, a lot of puts and takes still, and we need to hear the call.
We certainly do. All important. And now we're also going to be the first call since Reed Hastings stepped down and Greg Peters, the former CEO, moved into that spot. How do you expect it all, the leadership, the direction to change?
That's another thing. It can go either way. Hastings was the star of the show, so it's going to be an adjustment. We'll wait and see. The new management has been around. They know the business. They're plugged in, so it should be a seamless transition. But let's wait and see. It's nothing like the founders, nothing like the original guys, the visionary guys. They guide the company. But at this point, I think the company has moved on to the next phase of its development. It's more into profitability, more into efficiency. It's more about quantity. It's more about quality rather than quantity, which they have said already. So all those things requires good management, good execution. And I think these two executives are the perfect people for this. So net, I think it's a good transition. And they will do well. But we'll always miss Hastings.
Well, Santosh, speaking of things that the company is looking to going forward, live programming, and they had that massive glitch over the weekend with the live what was supposed to be the live airing of the Love Is Blind reunion. How big of a black eye do you think this is for Netflix? And what does it tell us just about their ability or lack thereof to be able to handle live programming?
I think they'll get a pass. If you ask me seriously, yes, it was not needed, should not have happened. But these things happen in live television. So I think they'll get a pass and they'll get the benefit of doubt going forward as well. So we'll see. I think one thing that's good for Netflix, and that's going to come in handy if the strike it comes true. The scripted television that Netflix has, that's ahead of the competition, that'll help them out. Plus, their international programming and the international footprint will help out, ride out any negative consequences of the strike if it does happen. So, in that sense, overall, it's well positioned. Yes, this live mess up was not needed, but they'll get a pass, I'm sure.
Also news, Santosh, that they have sent out their final red envelope actually in September. They will cease to send out DVDs. A sad day for a lot of people in America.
Yeah.
Santosh Rao, good to see you, sir. Thank you.